Sometime in the next 60 days, you're going to stand at a checkout, look at your total, and think, am I buying more than usual? You're not. You're buying exactly what you always buy. Same store, same brands, same habits. But the number is higher. And the frustrating part is there's no single thing you can point at. Nothing dramatic happened this week. No headline you missed. Just a quiet, persistent feeling that money is moving faster than it used to, with no obvious explanation. Here's the explanation. The tariffs that dominated every dinner table argument in 2025, the ones everyone debated, got angry about, and then largely forgot about. Those didn't disappear. They didn't get canceled. They didn't get negotiated away quietly in the background. They got delayed, and the delay just ended. Here's what's genuinely strange about the tariff story. When the announcements came in 2025, the economic commentary was immediate and unanimous. This was going to be inflationary. Prices were going up. Consumers were about to feel it. And then, for the better part of a year, the thing that was supposed to happen didn't. Prices didn't spike dramatically. The shelves looked identical. Life continued more or less as normal, which left people with one of two conclusions. Either the economists had overstated the impact, or something in the system had quietly absorbed it. The second one is correct. And understanding exactly what absorbed it, how long that absorption was ever going to last, and why that window has now closed, that's the entire story. When the first serious tariff announcements landed in early 2025, the companies that import goods into the United States did something entirely rational given the information they had. They looked at the timeline, did the math, and placed the largest orders their warehouses could physically accommodate. Not because demand had suddenly surged, but because they knew that every container arriving after the tariff deadline was going to cost meaningfully more. This is called inventory front-loading, and it happened simultaneously across almost every major import category as businesses raced to lock in pre-tariff pricing before the window closed. What that created was a 6 to 12-month cushion of goods purchased at the old price, sitting in distribution centers across the country, slowly making its way to store shelves. That cushion is what most consumers have been living inside without realizing it. Every appliance, pair of shoes, piece of clothing, or consumer electronic you bought in the past year had a reasonable chance of being sourced before the tariff hit, meaning the retailer had no particular reason to charge you more yet because their own cost basis hadn't changed yet. U.S. import volumes dropped sharply in Q4 2025, and the explanation wasn't softening consumer demand. It was retailers deliberately drawing down existing inventory rather than placing new orders at tariff prices. They were buying time, waiting for a political resolution, a negotiated deal, some off-ramp that would make the whole issue go away before they had to restock at the new cost structure. That resolution didn't materialize. And, at a certain point, regardless of what you're hoping for politically, the physical reality of empty warehouse space forces the decision. Reorders are now happening at tariff prices, and those costs are moving through the supply chain toward the register you'll be standing at in the next 30 to 60 days. This doesn't land everywhere at once. Different products have different buffer depths, different supply chains, different reorder cycles, which means different timelines for when you feel it. Here's what's coming and when. Electronics. Already here. Consumer electronics have among the shortest inventory cycles in retail. Turnover is fast, models change frequently, and warehouses don't stockpile last year's phone. The tariff impact on electronics started bleeding through in late 2025 and is now fully priced in. The average price of a laptop imported from China has increased roughly 15 to 20% from pre-tariff baselines. If you've bought a phone, tablet, or laptop recently, and felt like the price was higher than expected, it was. This wave has already landed. Clothing and footwear, landing now. The apparel industry ran deep buffers because seasonal inventory is planned 6 to 9 months in advance. Spring 2026 collections were largely ordered before the full tariff schedule locked in. But summer and fall orders are coming in at new prices. Analysts are projecting 12 to 15% increases on imported clothing and up to 20% on footwear by Q3 2026. The brands absorbing cost right now are running out of room to keep doing it. Household goods, 30 to 60 days. Furniture, kitchen equipment, tools, small appliances. These categories have longer inventory cycles because the products are bulkier and retailers carry deeper stock. But the buffer is thinning. Wayfair, Williams-Sonoma, and several mid-tier furniture chains have already signaled price increases in their Q1 2026 guidance. What they're describing as modest adjustments in earnings calls will show up as noticeably higher sticker prices by early summer. Auto parts, 60 to 90 days. This one is underreported. 40% of auto parts used in U.S. repair shops are imported. The tariff structure on components from Mexico, Canada, and China hit a category that American consumers have almost no domestic alternative for. You cannot easily source a replacement alternator from Ohio when the entire supply chain runs through Monterrey. Parts prices at repair shops are projected to increase 8 to 12% by mid-year. If you're driving an older vehicle and deferring maintenance, the window on doing that affordably is closing. Food inputs, 90 days and beyond. This is the slowest and least visible wave. Food tariffs affect packaging materials, agricultural equipment, fertilizer components, and processed food ingredients more than raw produce. But the compounding effect of higher input costs across the entire food production chain adds up. The USDA projected food-at-home inflation of 3 to 4% for 2026 before any of the current supply chain pressure was factored in. Revised estimates now run closer to 5 to 7% for the second half of the year. Here's where this gets structurally worse than any single tariff analysis captures. Retailers and manufacturers have two jobs right now simultaneously: absorb tariff cost increases on imported goods and absorb rising energy and diesel costs on everything they move domestically. For the past year, many companies have been doing the first job, eating the tariff margin hit, keeping sticker prices stable, hoping for a political resolution. Their margins have been quietly compressing. They no longer have the cushion to absorb the second hit. When a business that has already eroded its margins by 3 to 5 percentage points absorbing tariffs now faces a 15 to 20% increase in shipping costs, something breaks. They cannot eat both. The only option left is the price tag. This is the mechanism behind why price increases tend to arrive suddenly rather than gradually. Businesses absorb until they can't. Then they adjust. And when they adjust for everything at once. The tariff cost they've been eating, the energy cost increase, and often a small additional buffer for future uncertainty. What looks like a sudden spike at the register is actually 12 months of deferred pain arriving simultaneously. You're not imagining the checkout sticker shock. You're feeling a year's worth of delayed reckoning at once. Here's the thing that most of the tariff coverage has gotten fundamentally wrong. People treat this as a political story. Tariffs go up, prices go up. Administration changes, tariffs come down, prices come down. Simple cause and effect. The political lever goes one direction, the economy follows. That's not how supply chains work. The inflation you are about to feel in the second half of 2026 was mathematically locked in 12 to 18 months ago. It was locked in the moment importers placed their front-loaded orders, ran down that inventory, and had to reorder at tariff prices. That sequence is now complete. The pipeline is full of higher-cost goods moving toward your store shelf right now. The Federal Reserve cannot fix this with a rate decision. A rate cut does not reduce the cost of a container of goods that was manufactured in Vietnam, tariffed at the border, and is currently sitting in a distribution center in Ohio waiting to be shipped to your local retailer. The White House cannot fix it with an announcement. Even if tariffs were suspended tomorrow, which they haven't been, the goods in that pipeline were already purchased at tariff prices. The retailers who bought them need to recover that cost. This is not a policy story. It's a pipeline story. And pipelines operate on physics, not politics. The prices coming are not a reaction to what's happening now. They're the physical consequence of decisions made in 2025 that are only now completing their journey to your wallet. By the time most people connect their rising grocery bill or their expensive summer wardrobe to the trade policy arguments of last year, the moment to prepare will have passed. You're watching this now, that window is still open. What to actually do? 4 things, specific and connected directly to what I've just explained. Not generic advice. First, Audit the categories with timing in mind. If you need a major appliance, electronics, or household goods in the next 6 months, the case for buying now rather than later is unusually strong. This is not normal consume now advice. This is based on the specific pipeline mechanics I've just walked through. Prices in these categories are not coming down. They are moving in one direction on a documented timeline. Second, if you carry credit card debt, attack it before the broader inflation hits your budget. When 5 to 7 categories of your monthly spending are increasing simultaneously, the psychological pressure to put everyday costs on credit goes up. The people who enter that environment already carrying a balance are the ones who end up compounding the problem. Paying off debt at 22% is a guaranteed 22% return. Nothing in this market offers you that. Third, do not adjust your investment contributions. The inflation environment I've described is one of the best arguments for staying invested that exists. Cash erodes in an inflationary period. Equities, specifically broad index funds, have historically been among the best inflation hedges available to retail investors over a 5 to 10-year horizon. The volatility you're seeing right now is not a reason to pause. It is the cost of admission to the returns on the other side. Fourth, this is the one most people skip. Have the conversation about fixed versus variable costs in your life before the pressure arrives. Your rent or mortgage is fixed. Your subscription services are mostly fixed. But your grocery bill, your fuel, your discretionary spending, those are about to get meaningfully more expensive in a compressed window. The households that fare best through inflationary periods are not the ones with the highest income. They're the ones who made their budget adjustments before the squeeze, not during it. The most interesting thing about the tariff story isn't the trade politics. It's the timing gap between cause and consequence. Most economic pain arrives with a delay. The decisions that create it and the moment you feel it are separated by months, sometimes years, of invisible pipeline activity. By the time the signal is loud enough for most people to notice, the preparation window is closed. The inventory buffer was that delay. It was a year-long cushion that made 2025 feel more manageable than it should have. And it quietly expired. What's coming isn't a crisis, it's a correction. Prices catching up to costs that were always going to be passed through, just on a timeline that made them easy to forget about. You haven't forgotten, and that's worth something.